Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. There are many things to consider when picking a mutual fund to invest in, but knowing what to avoid or to get out of is just as important. Investors are always on the lookout for winners, but knowing how to keep the losers out of your portfolio should be just as important. High fees, the departure of a solid manager, or a focus on an overhyped asset class. These are some of the red flags that can erode returns or may even indicate a fund on the verge of shutting down. Let's cover and identify some of the major warning signs investors should watch out for, whether investing in a fund for the first time or for an existing holding. First, are you considering the investment and don't own it yet? So watch out for these. A useful starting point for investors deciding where to invest is the Morningstar's quote medalist rating, which evaluates whether a fund will be able to produce excess return after fees in the future. Morningstar's tracking shows that on aggregate, medalist rated gold, silver, and bronze funds outperformed funds rated neutral or negative in multiple periods after receiving the rating. Red flag number one, no clear path to profitability for the mutual fund company. With relatively low barriers to entry, investors should ensure the fund they're considering is going to be around for the long term. Make sure the fund company is on a steady footing in terms of their business, profitability, and sustainability. That can be relatively easy to identify with established firms with lots of funds under their management, but for early stage funds, there should be a clear path to profitability. If their fee is 1% per annum and they're managing 50 million in some funds, as some funds will be, that's $500,000 a year of revenue that they might generate. That's not really much to pay the rent and to pay salaries and to pay for Bloomberg terminals and everything else you need to run a mutual fund business, let alone making a profit to stay in business. Look for them to have some sort of financial backer or investor that's underpinning or providing a backstop and providing working capital to them to pay salaries and to pay costs for a term of, say, 5 years. So you know they will be in business for at least those 5 years. Firms backed by small angel investors such as Banalong or Pinnacle will often start up as loss-making enterprises with a pathway to break even and eventually be profitable. But there are firms out there that will start up with no backer, perhaps investing money from friends and family. Be more cautious with those and ask more questions about what the pathway to profitability and sustainability is for those firms. You don't want to go to the trouble of investing your money in a fund on a 3 to 5 year view, and in 2 years it has to shut down because it wasn't profitable. Red flag number two, the portfolio manager has no track record. This isn't uncommon at the small end of the market given the relatively low barrier to entry to starting up a fund. As a potential owner, you should know that the portfolio manager has relevant experience in managing the funds that they're offering, because it could be the case that they've got very little experience in the actual fund or strategy that they're managing and could have come from another asset class or style. You don't want them learning on the job with your money. The way that the small operators work is they will put out a person or a team from an established fund manager and then back them into starting their own business. The mutual fund itself should have at least a 10-year track record so you can see some history of its performance. Red flag number three, fees. Fees are a key consideration in buying a fund because they are the single most consistent detracting factor from an investor's return. This is largely because fees are charged regardless of how the fund performs. You should consider whether a fee is appropriate and fair, but also the way fees are structured. Sometimes the fee structure isn't appropriate and the fee formula doesn't use appropriate benchmarks. For example, a mutual fund owns equities and therefore takes on equity risk, but has cash as a benchmark. And then they charge performance fee for anything that outperforms over cash. Equities will outperform cash over the long term because they have more risk. If a fund is charging a performance fee on an equity return over cash, it collects more fees by using the wrong benchmark. Do keep in mind that all performance metrics and numbers are after the fees have come off. Red flag number 4, a fund has massively outperformed. When looking at a new fund, don't chase investment performance. If performance looks too good to be true, you just need to dig into why that performance has occurred. If a strategy has massively outperformed the peer group one year, it's more likely due to taking greater risk than just manager skills, and the mutual fund could take a dive the next year. The outperformance happened in 2019 to 2021, and then the dive in 2022 for a lot of mutual funds. Morningstar research shows investors often poorly time their fund purchases by buying too late and getting swept up in a market correction. For example, in the last 5 years, with the growth stocks rally, you've seen funds with concentrated exposure to tech stocks doing very, very well. You could have chased that performance, and then in this downturn that we've seen in the market in the last 18 months, and in all of 2022, those strategies have given back most of their return, if not more. Red flag number 5 is 3 or less stars on Morningstar. The fund's rating on Morningstar indicates its performance against its peers in the same category. If it has 5 stars, it's in the top 10%, and 4 stars, it's in the top 30%. If it has 3 or less stars, it is at best average for its category, which means it's not something to buy. Red flags number 6, it's not beating its index. A mutual fund should, over the long run, beat its appropriate index or benchmark. You can see this from the Morningstar graph or look at the number over at least a 10-year period. It's important to have a critical eye to performance and not just chase last year's winner. Now let's look at a fund that you already own. For those already invested with an established fund manager who has so far ticked all the boxes, don't be too complacent. Sometimes big red flags can pop up over time that make you reconsider your investment. Red flag number 1, the manager quits. The departure of a key portfolio manager can hobble a formerly solid team. Thoughtful succession planning can minimize the blow, but it is always worthwhile to assess an altered team's potential to deliver future outperformance for its investors. Portfolio manager departure is an issue because an active fund manager is a people business where the manager is the driving force for that mutual fund, and their quitting is a major red flag that should make you review an investment. If the portfolio manager leaves and there's no clear successor, then you don't necessarily know what you're going to get as far as a strategy going forward. It could be better, worse, or different, but in a good 5-star fund, the odds are it'll be worse, just by the law of averages. One of the most high-profile examples of the poor management of a key person risk was the departure of Magellan co-founder Hamish Douglas, for example. In December 2021, Chief Executive Brett Cairns abruptly resigned. In the same month, St. James Place, Magellan, then largest investor and its anchor client, also withdrew its mandate. This was followed by co-founder Hamish Douglas' indefinite leave in February 2022, which led to his resignation from Magellan in June 2022. Magellan was a gold-rated fund manager with Morningstar. Douglas's departure was very unexpected, and there had been no clear successor in the firm. The way it was managed wasn't particularly smooth. If the portfolio manager is going to retire, it should be well flagged with a transition process in place. Quite frequently, managers work as a team with others. There's co-portfolio managers, and if one of them leaves or retires, the other one is able to make the transition smooth. Red flag number 2, underperformance and outflows. Active funds are prone to redemptions when they underperform peers or benchmarks. Throw in big losses, which were common in 2022's rough markets, and investors become even more likely to bail. A wave of net outflows can make it tough for managers to buy companies they consider cheap, particularly if they invest in less than liquid stocks. When the mutual fund has to pay out redemptions during a downturn, those redemptions are taking away from the opportunity in investing in stocks made cheap by that downturn, making things worse. This is why you should be buying in a downturn in general. It becomes a concern if redemptions put the sustainability of the firm at risk, if it's a firm that has gone from being profitable to being unprofitable. It increases the risk of that firm shutting down, particularly if they lose a large institutional mandate. It's not unheard of. So that's a red flag because you don't want to have to put your money somewhere else. You want to be invested for the long term. Red flag number 3, capacity management. It's a red flag when a business looks to grow its funds under management for the sake of size. The mutual fund company should be growing their assets under management, AUM, in a measured and responsible manner. That's within their ability to manage without having detriment to impact on performance. It's more likely to occur in a small cap investing because you've got much more constrained capacity than, say, in global equities large cap when you can manage tens of billions with no real concern about liquidity. But when you're investing in small companies, there's a limit to size. It's a red flag if a fund is getting too big, particularly if you see that performance drop off because they haven't been able to trade as effectively as they had in the past. The mutual fund company isn't able to buy what they want at the current price because they have so much money to spend. As they start buying, the price comes up. The size of the mutual fund is definitely something to be aware of. Depending on what the fund is investing in, I draw the line at 10 billion assets under management for large caps and 1 billion for small company investments. Do note that a lot of mutual fund companies will close the investment to new investors to prevent the fund from getting too big. Obviously, this is a bit of a conflict of interest area because the mutual fund company is getting compensated on the amount under management, but it is to the detriment of performance if the fund grows too big. Red flag number 5, Morningstar rating has come down. The fund's rating on Morningstar indicates its performance against its peers in the same category. It's updated monthly. If the fund has 5 stars, it's in the top 10%, and 4 stars is the top 30%. If it has come down to 3 stars or less, it is at best average, which means it's not something to hold long term. Just a drop from 5 to 4 stars isn't a reason to sell the fund, but it's more of a yellow flag to see if the decrease in performance relative to its peers is a trend. Red flag number 6, it's not beating its index recently. The mutual fund should, over the long run, beat its appropriate index or benchmark. In the short run, the mutual fund may underperform its benchmark. That's a yellow flag. And you can decide how long you want to let that go on. 1 month is too short, 2 years is probably too long, unless the fund has a stated mandate that they're contrarian and they are building up a portfolio of something that's going to be cheap for a while and will do really well in the near future, and they're expecting this, but it's underappreciated today. Ultimately, you're looking for a well-performing fund that you can keep and have faith in long term. Some of the red flags are showstoppers, while some are serious warnings and something to keep an eye out on. Using these metrics, you can decide whether the fund is something you want to put more money in and keep your money in. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.